Hey everyone, my name is Oliver Turner. I'm the Executive Vice President of Corporate Development for Karora Resources, a Western Australian growing gold producer.
Good to see you, Oliver. Thanks for coming on. I know you're kind of getting all pumped up for being out down in Miami. You've got a Red Cloud event in Toronto. I think there's Metals Forum. And of course PDAC. Busy time of year for everyone. Look, let's start with the press release you put out this morning. But I kind of want to get into how things are going and how things are going to progress in 2024 in the context of gold is still really hard to read. But press release that you've put out this morning for us with regards to Fletcher, I think it was.
Yeah, absolutely. So, it was great to get those results out this morning on both Fletcher and Larkin. And just for a little refresh for everyone, Fletcher is that new shear zone that we identified early last year. That's west of Western Flanks. Western Flanks is the engine room. Beta Hunt, our primary asset, has well over 1 million ounces on it alone of the 2.7 million ounces that we have at Beta Hunt. Fletcher is looking like a Western Flanks analog. It is big. It's over 2 kilometers in strike. We've drilled that bottom 500 meters pretty densely right now. Of course, what we're aiming to do is get that into an initial inferred resource by the update at the end of this year. So we're drilling it like a bat out of hell. Every time we put a pierce point through it, we're getting tremendous results. Everybody remembers sort of the discovery drill hole on the southern end of it last year, which was a whopping 46 grams over 7 meters. I don't think anybody's upset with those kind of results. Certainly going to be interesting once we start mining through those areas. But we're also seeing some very wide widths, some fantastic intercepts in terms of the width of the zone. So this morning we put out a drill result that was 3.8 grams over 33 meters. So you're seeing both widths, which of course equates to tons, and then you're seeing these pockets of higher grade intercepts, which are tremendous. And the average grade for years at Beta Hunt has been that 2.6, 2.7 grams per ton. So every time we're intersecting some of these higher grade areas, it adds that potential flexibility in the future to improve head grades, which of course is all based on a fixed cost environment. Your fixed costs remain the same. The operation is all free cash flow. So Beta Hunt, as we've always said, it truly is a very, very large operation. It's a large ore body. Every year after year, we've added significant ounces to it ever since we wound back that royalty. Fletcher's kind of the next one up. It's looking like a big shear zone. And remember, when it comes to gold and nickel, even though nickel's not the flavor du jour these days, there's no occurrence at Beta Hunt where there is a gold shear zone without nickel on top. So that potential remains there. Then switching down to Larkin, again, just sort of steady as she goes in terms of the intercepts that we're delivering there. Not quite as wide as Fletcher, but that's okay. We're mining other areas that like A zone, which are obviously higher grade, but slightly narrower. And Larkin is continuing to deliver there as well. We had an initial resource on Larkin this year included, and we'll look to continue to grow that. And one thing that I do want to remind everyone of in terms of all your investors is that all of our mining for the last 4 or 5 years has only been on Western Flanks and A zone. All of those ounces that we've mined, over 400,000 ounces, has only been from there. So it's really important context when you start to think of the fact that we have 7 other identified shear zones, and some of them are as big as what Fletcher is looking to be. So when you start talking about 2.7 million ounces today, where could it be in a few years? Certainly much higher than 2.7 million ounces, which is starting to build that single critical mass for us to build a long-term future on.
Right. Okay. I like talking to companies like you because you're in production, you're hitting your production targets and guidance quarter after quarter.
Yep.
And I can measure you on that. I don't need to question your ability to mine, to build, to explore. Okay. So that makes it really easy for me. That said, you are in a position now, and I know we've talked about ramping up, and it's not 2024, it's 2025 in terms of your ability to kind of do that step change, and that's what I'm looking for from you. And I suspect that what your institutional shareholders are looking for from you is the ability to continue to deliver not only the kind of growth plan capital which you're applying to the exploration, but the meaningful and significant step change in production to become a true mid-tier. So can you just kind of run us through the kind of phasing of the different projects and in fact, how you're treating, how you're treating Fletcher and Larkin, for instance, as part of that mix, and part of that reserve building, part of that resource building?
Yeah, no, good question. And you're right. We're kind of on year 3 of that sort of growth plan deployment that we rolled out a few years ago in terms of that getting to that, roughly 200,000 ounces a year by 2025, which is what we laid out, which equates to, from a mining perspective, 2 million tons of rock per year mined by the end of 2024. So this year we're ramping up. We're going to do about 1.7 million tons this year. We did about 1.4 million tons last year. So it's that last sort of step to get to that annualized rate, which really turns this company into a much bigger company and turns the Beta Hunt operation into a much bigger operation as it stands this year. So remember last year we added those 3 ventilation raises. Wonderful. They're all switched on, full vent capacity, which has really taken the handcuffs or the shackles off the operation. And just for quick context, it's important to remember that originally we were planning on expanding the Higginsville mill to coincide with the installation of these vent raises. But when we bought Lakewood, we basically got all that extra milling capacity about 14 to 15 months ahead of time. So now the mine, let's phrase it this way. The mine is finally caught up to the mills. We've been able to fill those mills, no problem, but the mine is able to ramp up. So this year is additional stope development that goes in to get more working faces to deliver those 2 million tons per year. Look, one of the things that was very impressive in 2023 is with all of the new equipment that we have, and obviously, the great operation team we have there, we had some months where we did over 100,000 tons a month. Now, do some simple math here. You annualize that. That's actually over 2 million tons per year. So you start to think about where this mine could go in 2025 and beyond. 2 million tons per annum would be our starting mark. So it can get even bigger from a tonnage perspective. And what are the 2 levers of producing more gold ounces? One is moving more rock or more tons, and the other thing is obviously trying to improve head grade. So you asked about where Fletcher, Larkin, we also have Mason and Cowsill, which are coming into the picture now. How do those fit into our long-term mine plan? Well, currently, our current internal life of mine plan is built on current resources, which is what you have to do as an operating company, of course. And that's primarily Western Flanks and A Zone, a little bit of Larkin, a little bit of Mason, but no Fletcher in there whatsoever. So as we're drilling out Fletcher, as I mentioned at the beginning of the call, we drilled that bottom 500 meters, we get that into resource. And obviously internally, we're able to do things a little bit faster than as we deploy things out to the market. That's starting to add not only another potential source of higher grade ounces, and we'll see as we get there and start taking those initial cuts through Fletcher, but also, and this is something that cannot be understated, operational flexibility. And I know that's not a sexy term, that people get all excited about, but what it allows you to do is allows you to take tons from different sources and ensure that you're able to deliver your mine plan with a lower risk level. Look, there's always risk in mining. There's always things that go wrong that you have to overcome every single quarter. We do that. That's our job. When you have a whole nother set of working faces like we're going to have at Fletcher, it adds that additional flexibility to deliver. So potentially more tons, potentially higher grade, and certainly more operational flexibility just creates a more robust delivery of that growth plan. And then look, let's circle up, and once we have that resource out into the market, and let's start talking in 2025 and beyond, what are the levers that we can pull to make this thing an even bigger operation than it already is? Okay, so
but if I look at some of the targets that you've given guidance for, which is around the ASIC, which is like 1050 to 1200, higher head grade is going to help. Higher gold price is going to help. Yep. Talk to me about the other things that you're in control of, the other variables in terms of driving that down. Because the way you come at Larkin, for instance, you've got a little bit more fluidity there, haven't you, in terms of the way that you manage that operation?
Yeah, for sure. Look, I mean, that operational flexibility is big. And I kind of mentioned it with a little bit of a comment at the beginning of the call. Nickel is not the flavor du jour these days. Obviously, we're seeing a tough nickel market worldwide, right? And, I don't need to emphasize to your listeners and investors, mining is a cyclical business. Things don't go away forever, right? Things come back, and there's a reason why there's very large players making some interesting moves into nickel right now. Indonesia's been pumping out a lot of nickel. That won't happen forever at those cost levels. So nickel will come back. The wonderful thing about Beta Hunt is that we can turn that nickel on and off almost at will, because we have the existing operation there mining all the gold. And I'm oversimplifying things right now, but you turn right for gold, you turn left for nickel. They really are that close. We have the capability to ramp that up, whenever we want. And that is tremendous from a byproduct credit perspective. We also have the ability, as you increase the amount of tons that you're moving, obviously economy scale come into play. That's huge. Higher head grades certainly help. But I do want to make sure that everybody's aware, and I'm not going to say anything that anybody doesn't know. The sort of one sticking point that we certainly have in Western Australia, in the mining sector in general, and I would say worldwide in every sector, is labor costs. Labor costs, we've seen a lot of cost inflation over the last couple of years. Labor costs are sticky. You don't expect people to get paid 30% less a year from now. It's not the way the world works. However, what's really important is that we've seen those plateau over the course of 2023. And that is something that I think all precious metals and mining investors should be happy to see across the sector. And certainly in Western Australia, look, we've seen all miners increase from, let's say a base of 1,000 to 1,200. We see them add anywhere from $100 to $200 an ounce in their AISC guidance. What are the ways that we can potentially combat that? As I mentioned, nickel, as I mentioned, economies of scale and grade. And one thing I do want to mention right now, because we haven't talked since this press release was put out actually, was our recent PPA announcement. So we announced an agreement with a third-party power generator for a power purchase agreement. And one of the things that happens at Higginsville is, and this is very typical for Western Australia and remote mining in general, all of our power at Higginsville, which powers our mill, is our biggest power consumer, is generated from diesel gensets or basically HFO power stations on site, very large diesel generated power. And, at the peak of it, that was over 40 cents a kilowatt hour. For your viewers that are sitting in Manitoba right now, they're probably falling out of their chairs because they pay 3 to 4 cents a kilowatt hour there. But 40 cents a kilowatt hour, we're well below that now. What this PPA allows us to do, there's two things. First of all, it's a lower grid factor, which is wonderful in terms of your cost of carbon. But most importantly, the overall cost is lower. We're basically halving our power costs. The power cost savings are significant, and we should see that play into 2025. What's happening this year, we signed that agreement. Basically, we're tying into a grid. The grid connection is going to be built by the power supplier, not additional cost, capital cost to Karora. And then over the course of 10 years, we pay back the cost of that capital installment via our rate. But the most important thing to get to the crux of it is that you're going to see a reduced power cost for the Higginsville mill, which is another way in 2025 and beyond, once that's switched on. It's going to take this year to put that into place. You'll see potential cost reductions, or let's just say hedging of potential cost increases as well. So lots of levers that we can pull. We're heads down working on all these projects at the same time, which is a good thing, but we're in a comfortable spot.
Okay, so I'm not going to be shaken from... I need to understand the nickel contribution here, because look, ultimately I care about the margin that companies make, right? You guys got to make money, and I want to know where it's coming from. On the nickel thing is, okay, I've tried once, I'll try another way, which is nickel's at what? That's, I think this morning, last night, 17,200. Okay, was it 20,000? And end of October-ish, right? So it's kind of like bouncing around a bit. Given the contribution from nickel, potential average contribution from nickel, do you reallocate resources into gold where you're starting to see these much higher grades and just rein back the nickel component for now? Or can the ship not turn that quickly and actually just kind of got to ride these waves, as it were?
Beta Hunt is it's a good question. Beta Hunt is a very unique operation. And I would not say this honestly about any other mine in the world. And, I spent 7 years as a mining analyst visiting dozens of these operations all over the world on a yearly basis. So it's certainly a very unique operation in the fact that all of that infrastructure, remember, it was a nickel mine for 35 years, 400 kilometers of existing development that cost you $2 billion to build today. All of that was put in place to mine the nickel. We've now been using that same infrastructure to mine the gold that's immediately next to it. Beta Hunt is a unique capability in how flexible it is. Of course, you can't make a week-by-week decision, but can you make a 6-month by 6-month decision? Absolutely. To switch something up or to ramp it up or ramp it back down based on the nickel market. There aren't, by definition, you either have a nickel mine or you have a gold mine. And if you're only nickel, obviously you're seeing a lot of them shut down right now. It's tough times. And when gold prices, roll over, there's certainly lots of gold operations that shut down all over the world. Here we have the capability where we are a gold mining company through and through. That's who we are. That's our identity. And that's what we're focused on. We're building and ramping up our gold operations. We have this incredible capability with over $700 million at current valuations of nickel in resource today that we can mine that or tap that basically when nickel prices are in a place that we want to mine it at. So the ability to throttle there is unique. not a week by week decision, maybe a semi-annual by semi-annual decision. But what you said is, is definitely accurate. The fact that we see a resurgence in those nickel prices, you can bet your bottom dollar we're going to be switching to reallocating some more resources in there. And look, remember, this is our last big capital year at Beta Hunt with respect to the growth plan, right? Getting all that development in place for that long-term future at 2 million tons per annum. Plus, once we're into 2025 and that, the capital program is pulled back, we have even more resources to allocate into certain things. Free cash flow goes up. We can make better decisions when it comes to, or I should say, less encumbered decisions when it comes to where we allocate our resources. But as it stands right now, heads down, focused on the gold program and getting that ramped up, and that'll be our long-term basis for the future.
Okay, so the guidance for this year is 170 to 195, and I'll be looking each quarter to see if you continue to deliver, at or near that. We're all very interested in the gold price at the moment, sitting just above 2,000. We've had a conversation now where you've been talking to me about all the things that you are mostly in control of. Obviously, Mother Nature has some say in that, but you're hitting your targets. The things that are not in control, clearly what's happening in the equities market broadly. Last 3 years, absolute nightmare for gold companies because the normal rules have not applied. We said it at the time, we said it the whole way through, and nothing's changed there. This should be the perfect environment for gold. I'm not asking you necessarily to make a forecast about when things move, but when things move, how does that play out? Do we get this accretive growth? Do we get this violent growth? I mean, what do you see? And what would you therefore say to your current shareholders and existing shareholders? Compared to how the market is actually valuing you at the moment?
Yeah, for sure. And look, I mean, there's a reason why people own gold equities, right? There's gold bullion, which the old adage is, you don't hold gold bullion to get rich, you hold it not to get poor in your portfolio, like broadly speaking, in large portfolios. When it comes to gold equities, that's when you want leverage to the price of gold, right? And it is very, very extreme leverage, especially with levered gold producers or producers that are like us that are scaling as well. When prices start to move, or what I should say is when capital starts to flow back into the sector, whether it's generalists, which obviously have been getting further and further away from the sector over time, or whether it's new capital comes into specialist funds. And I know of two over the last several years that have started up, which is good news for the sector. One of them is one of our investors, which is wonderful to have. When capital starts to move into our sector, you look at the combined market cap of the sector, it's not that big. I mean, it's smaller than the market cap, or it's a fraction of the market cap of single tech companies, right? So when capital starts to move back into the sector, there's only so many homes for it to go. And it kind of has a cascading effect of priorities. So typically speaking, one could say that the creation of the minor ETFs kind of ate the lunch of the producers about 10, 15 years ago. So you have the GDX, GDXJ, then you have the royalty producers, the Franco-Nevadas of the world. So first ports of call are typically VanEck, GDX and GDXJ. Then you have the royalty producers. Then they go to the big boys, the Newmonts, the Barricks of the world. And then once the trade is really on and people are looking for more exposure and more leverage to it, they come down to the intermediate and mid-tier producers, and then, of course, down to junior producers. And that's where things get really fun. That's where you want to build a position in companies that you think are going to be still stable over the course of the next period of time. Again, I'm not going to take my crystal ball out and say it's going to be, April 1st when things, that was an April Fool's joke, I promise. April 1st when things start to ramp up. I'm going to say that when things do, you want to be positioned in companies that have that leverage, but at the same time are still going to be able to move forward with their strategy and their capital plans over the interim period. That's what these financed, cash flow generating, growing gold producers are able to do. That's what Karora is able to do. We're able to execute on our plan. No matter what, we got over 80 million in cash. We're generating good margins here while building the business. We get into 2025 and beyond, and this thing starts to generate serious cash flow. And once that sort of sectoral trade is on, these are the names that move very, very quickly. So there's an element of, with all of us, we're all mining equity investors, an element of, patience, an element of frustration in terms of where the market's been, but an element of anticipation for when it turns. Sometimes you don't even want to miss those first few days of the trade because things can move 20, 30% that quickly. It's a great sector to be in from that perspective. And that's why you want to own stocks like KRR.
Yeah. And do you think that you're allocating the capital the right way in the sense that you've got a big land package? you continue to find an increase, increase in grade really helps as well. So scaling up with the existing portfolio is the right thing to do. We've seen a few companies make a few moves. There's a few bidding wars. There's a few kind of big acquisitions going on out there. There's also been a few companies fall over. So it's a very interesting dynamic environment out there. Do you feel sort of comfortable in the strategy and maintaining the strategy?
100%. Absolutely. I mean, look, we've laid the strategy out years ago. We've executed on it every single year. Internally, we're always working on a 3-year plan. That's how we roll things forward. We don't think in terms of next quarter. We think in terms of the next 3 to 5 years and where do we want to be. And in the mining business, your job is a few things. First and foremost, to mine safely and bring people home. Secondly, is to generate cash and build a business to make money. Third is to make sure that no matter what you're doing, look, you mentioned it before, this is a sector that, basically grows via eating other companies. You always want to be attractive as well. You want to make sure that you're not doing anything to change that story from an acquirer perspective. So we want to make sure that we're delivering on all 3 of those at all times. We have been for years. And ultimately, that's what delivers shareholder returns in the sector, especially on a relative basis. Look, the whole sector trades down. You want to be one of the names that flat. The whole sector trades up. You want to be outpacing the rest of the group. And the whole sector is rolling over. You want to be one of those that's remaining standing. That's the way that it works. And that's what our strategy is.
Right. Okay. And then just this one for retail, but it's one for retail by looking at what institutional guys and gals and even the analysts look to you and see. Okay. So you're getting some pretty hefty target prices from the brokers, right? All good. You've got some big shareholders in the shape of Invesco and Eric Sprott and Banach and all the usual suspects in there. They continue to hold, and you got a lot of them. What is it that they're getting from you that they couldn't get from elsewhere, or are you just part of a sort of interesting group of producers who continue to generate cash? How do they view you?
I'd say there's a niche in the market right now. There's probably about, I would say, 5 to 7 companies that fit the bill of a growing junior gold producer that has ambitions and a plan and an executable strategy to be a mid-tier and intermediate producer. We're right in that pack. There's only 5 to 7 of them. It's not a big group. That's a very good place to be. As we all know, and you talk to dozens of these companies, when you move a little bit lower in market cap or a little bit earlier in stage, I mean, let's not kid ourselves here. There's some amazing projects around the world. Being an unfinanced developer in this environment over the last several years has been very, very challenging, both from an acquisition perspective and from a project finance perspective. Being a small explorer, look, there's been obviously some wonderful discoveries, but it's been hard for the majority of them. So this is a niche that the bigger guys want to dip their toes in. You talk about the Invescos. Look, Invesco is the second largest gold fund out there. It's a very, very large fund. We have a big allocation in their portfolio. For the size that we are, we have a big allocation. So those guys, when they pay attention to you and they want that extra, let's call it alpha, or that extra leverage and exposure to the sector, you want to be on their radar screen. And you look at the shareholder registry of some of the other groups that, let's just say, purport to be in the same position as we are. They don't have those shareholders. So I think the shareholder registry speaks for itself. So when it comes to retail, obviously everybody wants to see share price appreciation tomorrow. We all do. We're all shareholders too. Absolutely. This is how we make a living. But it's important to pay attention to what are the large fund managers owning. Take a look at shareholder registries across the businesses that you're taking a look at. Where is the smartest money sitting or the biggest money sitting? Get some exposure to those stories. Hold on to it, ride the wave. And when that thing switches back on, you're going to make a lot of money. And these will be one of the names that you'll do it in.